Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. We're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, and most of the time it's related to three different topics: financial topics, wealth topics, and/or um, commodities. So let's dive in. Let's take a look and see what people are talking about. If you want to follow me at Finance, if you want to join our community, finding-value.com, we have a discount going on called LEAP, LEAP, in the discount code. If you want to save some money and join um, a channel that's got a Discord and question and answer sessions on the weekend and midweek updates, which I'll release today, in fact. So, Peter Lynch says stocks are a safe bet, but only if you stay invested long enough to ride out the corrections. And that's what I found. If you invest for the entire market condition that is a tailwind for your investments, they are a safe bet as long as you buy when they're cheap. That's what the ratios are. It's the three pillars that I follow: ratios, market conditions, and technical analysis. If you got a good bottom at a very good ratio, a good bottoming pattern with a very good ratio, and the market conditions are changing in your favor from, say, low inflation to more inflation, which is the real estate cycle, then yeah, they're a pretty safe bet as long as you can hold on to them long enough. And I talk about a commodity super cycle that is coming, that we're in, not just coming, but we are in it. Some people think when I say a commodity super cycle that it just goes straight up, like commodities will just do this. They're going to go up, they'll pull back. Then they're going to go up, and then they're going to pull back. That is what makes it a super cycle, is that you have multiple moves to the upside and multiple moves to the downside, corrections. It's a stair-stepping pattern that I always talk about on the daily matters. But the corrections can last a year or 2 years in the beginning of these big bull markets. It's not just straight up. And I think that confuses a lot of people. They'll say, "Oh, look at this commodity super cycle," and I'll be like, "Dude, it's still game on. It's just a matter of investing long enough to ride out the corrections." Peter Schiff says investors still don't get it. Today's hotter than expected consumer price index doesn't mean the Fed just needs to fight a bit harder to win the inflation fight, but that it's already lost. It's not just a matter of delayed rate cuts, but the horrific truth that high inflation is here to stay. I mean, that's Peter's opinion there. We've got Ben here. He says finance is one of the only industries where people can be wrong about everything all the time, yet investors still listen to their opinions. Sir, you've been wrong about the economy and financial markets for 15 years. Care to tell us what you think will happen next? And there's been a lot of people that have been calling crash after crash after crash. And there's a lot of people that say we're going to melt up and do all these different things. What I will say is there are cycles, and those cycles play out with certain metrics. There's a lot during the cycle. Sometimes you get metrics that cross against each other. So some are positive and some are negative. Much like the dot-com bubble, and even here recently with the inverted yield curve, and it's staying inverted for a pretty long time. The stuff I look at is still economy is still positive in terms of the real estate market, but there are metrics that would go against that positivity. So calling and predicting market tops and bottoms and doing all this is extremely difficult. What I think you want to focus on, and we used to focus on this in engineering, what is the given? If you can do things where you can make calculations and say, yes, we are for surely cheap, or yes, this asset is for surely expensive in relationship to history. And that is what I consider to be like the given. It's the conditions. So you sift through all these different conditions and you say, this is cheap, this is expensive. Then you look at all the cheap stuff. You say, okay, well, why could this go up? Is it a tailwind behind this sector? If the answer is yes, and it's improving, And then you look at the inventory levels, and the inventory levels are declining. It's like, this is where I want to be. Because if you stick your money in a basket of cheap things, you buy things when they're cheap and then you hold on long enough, that's how you make money. The market's going to cycle back around. It is very hard to make money trying to time stuff in the short term because almost everyone gets these predictions wrong. You can do it with some degree of accuracy, but you have to be very disciplined. And it's not just being disciplined. I mean, you have to, it's basically your strategy that's working. It's not necessarily making right calls. It's more or less a strategy where you cut your losses really short and then you ride your wins pretty heavily. So, I mean, that's really how some of these guys have made it. They made a lot of money on very few calls. They were wrong more than they were right, from what I understand, on some of these, best of all time investors. They just piled into something that was had a huge asymmetry, and then they put a bunch of leverage on it if the probability was high. But most market timers, they most of the time get it wrong, or a lot of times they get it wrong. Volkswagen's realizing the future might not be exclusively EVs after all. Not only is the company halting EV production at its German facility, but it's adding weekend shifts to accommodate for the increased demand for ICE vehicles. Big narrative shift. Now, here's something. If we're not building EVs, which I don't think there's a chance that we can build all electric vehicles because we'll run out of the materials to build it with, we're going to go hybrid most likely. That's what Toyota is banking on. And I would bet on Toyota over any of these other companies. So Toyota's banking on hybrids, and that's going to need a lot more catalytic converters. But we'll run into problems most likely with materials to feed these things probably in 5 to 10 years' time, is my guess. And we could even squeeze the crap out of energy in the meantime. Energy being oil. So yes, people may prefer ICE vehicles because they're 1,000 times better than electric vehicles in terms of convenience, unless you are just doing short-term trips and can charge it in your garage. Then that's the ultimate win. But if that's the case, you could probably do that with an electric scooter and just skip the car entirely. And then you have a lot more garage space and just a scooter to use, a little electric scooter, because they go 40 miles an hour. And if you're only doing short-term little things, that's not too bad. Crude is up more than 1%, and every oil stock on my screen is red. Consumer price index is red hot. Bonds are on the lows of the days, and everybody out there seems to be buying NVIDIA calls, while UBS drops a massive price target increase right at the open. And he feels like I'm taking the crazy pills for Calvin. And guess what, guys? That happens in markets. It's sentiment. And right now, the sentiment is garbage in crude oil and natural gas and anything fossil fuel related, coal, which is when you want to buy. You don't want to buy when something's got high sentiment and everybody's in it. You want to buy it when no one's looking at it. And you just accumulate. You know, my my family knows like one very, very wealthy person. She her parents owned a company and they made a lot of money, like billionaire almost. And she would basically just go around and accumulate assets and never sell. That's like what their family did. So they have homes in like Italy and I don't know where else they have them. I know they have one in Italy and one in the United States, but she moved outside of the United States. But they just accumulate assets and then hold on for basically their life. They just accumulate stuff. And that's kind of what you want to do. You want to find stuff that's cheap. If you bought a house when it was cheap in 2011 or 2010, perfect. I mean, the house prices since then have gone way up. And if you just kind of hold on through all these different market cycles, I mean, that's exactly what Buffett says. He says, buy stock and never sell it. That's exactly what really rich people do. And if you want more income, buy stock that throws off dividends and just don't sell it. Um, in the commodity space, they're a little bit more cyclical. So you might have to time it a little bit. But overall, most stocks that control the selling price of their products, you basically just buy it and hold on forever. I mean, that's really what it is. But sometimes the sentiment isn't in your favor, even if the price of whatever it is goes up. Coming on down, Handra van Heerden. This guy is in for a massive surprise. And Eugene says, unless it becomes a widely used medium of exchange, Bitcoin should eventually implode. The alternative is that all I learned from monetary theory about how currencies acquire value is meaningless. So, based on what he um, has studied in history, is whatever medium of exchange, it needs to become widely used. Otherwise, it will eventually implode. I would agree. I don't see why, if something isn't used as a medium of exchange, it will eventually implode. Completely agree. If it is supposed to be a medium of exchange, not a commodity. Gold, silver, platinum, those are commodities as well. And they derive value from its utility to all these different designs and industry. But Bitcoin, we'll see. We'll see if the design of Bitcoin can last the test of time. All I'm going to say is when the miners don't get subsidized, each halving is going to wreck the miners because the miners are going to have to put larger and larger fees onto each transaction for the transaction to exist. And as it continually, basically, you have to mine more to get less, so to speak, there's going to be greater and greater fees with Bitcoin. Copper could skyrocket over 75% to record highs by 2025. Brace for deficits, analysts say. I mean, this is a really good spot to be looking, copper. But when I look at that, I just think, man, you know how much more energy we're going to consume if we try to ramp copper dramatically with low ore grades? I don't know. I'd much rather be in energy, but this is one way you could play a deficit or a commodity that's going to probably go a lot higher. He says, am I down today? Yes, but I don't even care as long as the MAG7 burns to the ground. If we have to take everything down to destroy this fake economy and fake market, so be it. I'm ready. He's got Microsoft, Apple, and all these other things. So I know he's short the big boys up there, but guys, these bubbles can last longer than what you think. And this is a patience game. It's like running a marathon. It takes a long time. And well, a long time for a lot of people. Pretty short time for some that can really haul, and they can do it in like 2 hours or something like that. But for the most part, though, yeah, I wouldn't be shorting. That's just me. But here's natural gas. Facts don't lie. Weak hands would capitulate at these levels, but this is once in a lifetime buy opportunity. First one came in 1992. Next one in 2020, which I partook. That's the one I loaded up in. Third one is right at doorsteps. $3.50 to $4 this year is reasonable. And that's what he's saying to the upside. But yeah, we could come down to the low $1 range and then rip it. But that's exactly what we did in 92. It was 165% gain. Here's 138% gain in a very short period of time. And then we're probably going to see a big move off the bottom here again. It's going to be a slingshot cheetah at some point. Are we there yet? Probably not yet, but hopefully soon. Peter Schiff, higher inflation doesn't indicate a stronger economy. Prices are rising due to the excess demand created by Federal Reserve deficit spending, consumer credit, and past QE, and also low real interest rates. The underlying economy is weak and it will weaken further as inflation strengthens. So that's Peter's opinion around the inflation that's being created today. We've got natural gas here. The absolute obliteration of natural gas continues as it has fallen to fresh 3.5-year lows. How low can this thing go? I think maybe even as low as this bottom here. And I think this is a lead-in pattern where we're going to do a double bottom. And it looks like we could almost go down to $1 or so as a potential buy point. But that's not how I operate. I'll get in a little bit early. I'll probably cost average in, sprinkles, and play it with some of the equities, which the equities aren't falling down that much. They are a little bit, but they're not falling like this commodity price has fallen. And remember, a lot of them have hedges in place, and they're growing. They're going to grow production over the next 5, 10 years. We've got a lot of natural gas power plants coming online all over the world. It's probably one of it's the fastest growing fossil fuel power plant generation. It's absolutely dusting nuclear at this time in terms of percent growth. And a lot of coal power plants have been replaced with natural gas in the United States and all around the world. JC says, I keep being told to ignore these and to not be short stocks. Do you agree? And this is the S&P percent above the 50-day moving average. Above the 200-day, it's falling, falling, falling. And then we got the S&P going up. That's the divergence that some of these guys are looking at to put on potential shorts. Now, I don't short stuff. I like going long and staying in it. I'm shorting, you're betting on something going down in the face of what could be rapid inflation. So I'm not cool with that, but he can do whatever he wants. But this does look a little bit weak. Crazy stat from Eric Nuttall says the top 6 Permian producers with a 32% base decline rate need to replace the equivalent of one Canadian natural resources, 1.4 million barrels of oil equivalent per day, every single year just to stay flat. We believe the era of meaningful shale growth is largely over. Agree. And if we don't grow from shale, this world's probably going to peak in oil production soon. I'm going to guess this year or next. It would be my guess. Calling all contrarians, investors are the most long tech and underweight energy since 2020. 2020 keeps coming up here. When a certain AI stock is worth more than all of the largest US oil and gas companies combined, you know the pendulum has swung very, very far. We suffer from a sentiment challenge, not from poor fundamentals. Buybacks will be key to improve sentiment and demonstrate strong fundamentals in terms of free cash flow. And this is what I'm looking at is this chart over here. We're way over here in terms of sentiment and how it's swung back. And this is going to swing all the way up and then come all the way back. This is basically that clock that we look at. Tech is in the right hand, so that's leading, and it's got a lot of momentum. This is weakening and lagging as you go back to the left. So the clock, you basically cycle around, come back up, so it improves and momentum comes up and it starts to lead, and then we go back around in a circle. Energy is in a perfect location to be looking for potential entry points, in my opinion. Coming on back. Investors are all in on tech stocks per Bank of America. So you want to buy in November of 2022. You want to sell somewhere here very soon or now. That's what I would do. But I'm looking at other stuff that's way underpriced in relationship to any of these tech stocks. But they could continue to go higher. It's a possibility. NVIDIA, not a bubble. This is what he says. And then he compares it to the largest bubble in history. So, yes, it can still be in a bubble where we're at today. And this is just the largest bubble that you're comparing it to in terms of the NASDAQ. And this is based off of, I think, their valuation that they've got. This is rebased at 1995. NVIDIA has to 3x in 433 days to be at .com bubble levels. This guy is false. You can be extremely expensive in a bubble and go down from right here. It doesn't have to be the biggest bubble in history. So I don't know what this guy is trying to do. He's like, oh, we'll compare that to the largest bubble in history. Oh, or one of the larger bubbles in history. Oh, but since it's not this, it's not the exact thing. Just because a bubble goes to a certain valuation level doesn't mean all bubbles go to the same valuation. This is a bubble. And if you miss out on this last move, so what? Because look what happened after it. Now, to me, this looks like a wave 5 move that we're in right now. How extended is wave 5 going to get? I don't know. I'm not going to be there. I don't really care. Are commodities undervalued when compared to long-term averages? The answer is yes. And we are at very low levels in terms of our commodity to S&P 500 ratio. Another thing is we are at the largest bubble that the S&P 500 has probably been in. So commodities are really cheap and we're at very big bubbles for stocks. Here's Steve. I wanted to go over this one here. This is an interesting one. He says the system is rigged. It's rigged to pay you the bare minimum, hoping you don't care. They didn't see me coming. I wasn't paid what I thought I was worth. Then I changed everything and forced my salary to boom. So here's how he did it. He switched companies 5 times in 14 years. Each move got him 15 to 20% raise. Switching companies is the best time to boost your salary. It's part of the process. Company loyalty is a scam. Be proactive, move often, but not too often. I negotiate salary when hired. Never accept the salary offered unless it's amazing. And never accept the bull crap line that employees get raises later. That doesn't work. Asking for raises later is 100 times tougher than negotiating a higher salary when hired. I sought out important tasks. Most of my coworkers would barely do what they were told. That's it. The bare minimum was good enough for them. It was never good enough for me. Want to get paid? Then do something worth getting paid. Do more, be better. Yes, this works. I showed up every damn day. Showing up is half the battle. Every day, be there, be present. I showed up at 6 a.m. in the office every morning and got opportunities others didn't. Why? Because I was there, usually before my boss. I worked with my I worked with my boss, not for them. My boss trusted me. I told the truth even if they didn't want to hear it. I took an active interest in their side of the business. That's why I was promoted from developer to director in one day. I wasn't a yes man. If you work for a boss who likes yes men, it's time to find another job. Good bosses appreciate the truth, and those bosses also recognize the value of honesty. They pay for honest people because so many aren't. If the answer is no, say no. I asked for raises after major accomplishments. Quit relying on a 3% cost of living raises to boost your salary. That's a sucker's game just to keep you from bailing. 3% raises are bullcrap. Do good work constantly. Then use that work to get paid what you're worth. I stopped bitching. Let's be honest, when I was a director, I kept a list of GEEs, good enough employees. These were the staff members who did just enough to avoid firing. They never get promoted. Constant complainers found themselves on that list 100% of the time. I looked out for the needs of my employer. You're not there to get paid. You're there to build a business you work for. Know your business inside and out. Why? Opportunities. That's why. Once your boss discovers you care, there's nowhere but up for you. Throughout my career, I averaged a 15% increase every single year, earning 6 figures by the end, which was good money back in 2015. Either proactively boost your income or forever sit at the table of cost of living 3% increases. He says you don't need to earn 6 figures to be a millionaire. I wrote a free guide, etc., etc. I agree with most of this, but what I will say is you got to make sure that you find a boss that will actively be on your side. They need to promote you and be a part of your progress. If you get a dud, you got to leave immediately. There are a lot of dud managers, and when you go and you interview at these places, you need to go in there to see if the place is right for you. You need to be asking a lot of questions for them. You need to ask and be basically in the seat of power. You know, I just went through an interview. I applied for the heck of it. They wanted to interview me. And I asked this hiring manager, I said, hey, what's it like to work there? What's the culture like? And his response was, well, I've been here for 20 years. It's really nice. It's good. And I'm like, that's you selling me on the culture? You're just telling me that you work there for a long time and it's nice? Really? That's how you're trying to sell me on this position? And then I was telling him a whole bunch of other things about my background and history and the things that I worked on. One of those things that I talked about the ERP system of SAP. And then the next question that he asked me was, have you worked with any ERP systems? And I'm like, did you not listen to what I just said? I mean, this is ridiculous. Do I want to go work for someone that's like that? No, heck no. And this guy is a manager at a large aerospace company. Really? You got to be real picky. You got to be real picky on where you want to work, guys. My friend said he would never achieve financial freedom due to the financial responsibilities of supporting his family. He has 4 kids. He drives a Tesla. Wife drives an Escalade. He makes 175K a year. Wife makes 125K. Should you empathize with him or point out their priorities? I wouldn't do anything. I wouldn't even be friends with this person because obviously this person's kind of retarded or stupid. Sorry, I'm going to remove retarded and put stupid. This person's stupid. I mean, it's great that they make all this money, but financial freedom, he doesn't care about that. He doesn't give a one licking crap about it if you're out there buying Teslas, Escalades, and then making excuses when you make, what is that, 300,000 bucks a year? Yeah, you should be able to be financially free if you want, if you want to, if you want to. But I know people that are like this. I just don't hang out with them. I'm a saver investor, and I like talking about ideas. That's where I go. A lot of these people that are like this, and I'm not saying all of them, but a lot, what they do is they talk about the crap that they own. It's like I don't give a crap about what you own, but a lot of people do. This is JC. He says, I think I like rug pull season better than football season. We're adding to bearish positions because, like in football, it's a lot more fun when you're on the winning team. He thinks this is going to probably turn and head lower. We got the 14-day RSI rolling over, and I do think that we could get a pretty big pullback in the NASDAQ. Now, in the NASDAQ, is that going to be similar to the uranium stocks? Because uranium's been trading along with the NASDAQ, and if you look at history, some of those NASDAQ moves has moved with uranium. Are they connected? Are they intercorrelated? Maybe. I mean, we'll see. We've got another Peter Schiff here. He says, as I've been warning, the January CPI data confirms that inflation has bottomed and is now heading back up. The higher than expected 0.3% rise annualizes to 3.7%. The 0.4% jump in the core annualizes to 5%. Without additional rate hikes, there's no chance inflation will return to 2%, according to Peter Schiff. This one's Grady. Fighting inflation has never, as such, has never been a priority. M2 is starting to go parabolic. Gold will always catches up to the M2 and CPI. Stock market is a function of the currency supply. It's all started when Nixon disconnected the USD from gold. Completely agree. And the M2 money supply is starting to go vertical. Yeah, we had a little bit of a pullback recently, but it's probably going to keep ballooning. Crude oil and the inflation rate relationship since 1861. Let's take a look at this thing. So when oil goes up, so does the inflation rate. You can see it almost every single time. They are interconnected. Inflation, oil is the most inflation sensitive commodity. It's also the translator of inflation into real things. So oil, I think, is a great bet. We've got a continuation breakout that we've broken out, done a retest, and this thing's ready to potentially break to the upside. So if we see an upward move in inflation, oil will most likely follow. Inflation is driven by credit expansion and or deficit spending with that interest expense and also fiscal spending. And it's going to translate through oil prices. Oil is the most sensitive to inflation of any commodity. And I think that's probably where I will end it. So I'll end it there. That's what I've got for today, guys. So give me a thumb up. Subscribe to the channel if you haven't. Subscribe to the website if you want, if you'd like. We have a question and answer session at 7 a.m. Saturday is our next one. All right, guys. We'll catch you later. This is Finding Value.